All right, good afternoon, everyone. Thank you for joining our financial and market update session today. I'm Jeff Carbone, certified financial planner, managing partner at Cornerstone Wealth. Of course, joined by our chief investment officer and chartered financial analyst, Cliff Hodge. So welcome, Cliff.
Thank you, Jeff. Great to be with you as always.
Absolutely. Well, yeah, Cliff, I don't know if we could talk about markets and without using the Cliff Notes commentary, because I know many folks do get your Cliff Notes on a regular basis. And just a reminder, those are sent out via email and are posted to our website. So, today's webinar is a little bit of a continuation of that. And we certainly have had a little bit more activity in this market, have we not, Cliff, since you wrote that. So, just a reminder to go visit the website on a regular basis, and you can kind of see or read some of what's going on and from the investment committee and investment team with Cliff and team. So thanks. Just a reminder, we're recording the session. It's always going to be available on our website. We'll put it on the Facebook page. We'll post it to the YouTube channel, and we'll email it for your reference, as well as if you want to share with family, friends, or colleagues, just to kind of spread some of the commentary and thoughts from the investment team here. Today, as we start, just a reminder, the mission that we have as a firm and of today, and sometimes we hope to accomplish this, but we want to provide that clarity and confidence, again, as the cornerstone of our clients or your financial life. Wish we could start with a little bit better news, because the market's S&P 500, well, I guess we're starting with better news because the market's closed up this afternoon, Cliff. But S&P did hit the bear market territory on June 16th. If we look back a week or so back, markets were down, closed down 23.6%. And you can correct me if I'm totally off on that, but maybe a percentage point or two. But, when we look back just 5 months ago, in the new year of 2022, January 3rd, 2022, markets hit or S&P hit all-time high. And now just 5 months later, again, we're hitting that bear market territory. Reminder, market recoveries, they happen and they take time to happen, right? Bear markets happen and recoveries will happen as well. So we're going to talk about that and what we're seeing. Again, this is officially probably the 11th or 12th bear market we're seeing since 1950. So another reminder is that since 1950, if we've had 11, 12 bear markets, we've had an awful lot of bull markets as well. So things go up, things go down. We all know that. We just don't like when they go down. So we're going to talk through some of this today. We also saw a few weeks back that yield inversion. And if just from a high level, yield inversion means the 2-year treasury and the 10-year treasury. Actually, the short-term 2-year pays more than the 10-year, and which is usually a leading indicator or an early indicator of recession on the horizon. And we're going to talk about that today as well. If we add on top of that the pressure that we're all seeing and feeling, the Fed tightening cycle that has begun back in March and has moved a lot quicker with Cliff will go over that 75 basis point hike that we had just a week or so back as well. We have the persistence and continuation of supply chain issues, the lingering of COVID. It is not behind us. And of course, the Russian war with Ukraine that has continued to wreak havoc around the world. Despite all the challenges we see and we've been under, the consumer and businesses remain healthy and in good financial shape. So we're going to talk about that today. We're also going to talk about, again, the R word, the recession. Many analysts believe the recession is on the horizon, but we may talk about how we don't maybe see it as imminent as others. So it could be a 12 to 24 months. We'll talk about that as the Fed marches down its role to control inflation, or as well as keep people employed, inflationary pressure, but also employment pressure that's out there. We also know fear and greed are the key emotions or drivers of many things, especially in management of money. And the emotion of fear is at its highest and the primary driver at this time. So again, fear and greed, we want to talk more about. When fear is high, it's not the time to sell and get out, but why you make a change and reposition if needed. So in our agenda today, we're going to discuss all the market conditions, the economy, inflation, as I mentioned, the Fed, and of course, we're going to talk about where we go from here and what we've been doing. So Cliff, thank you again for joining. Let's get into it. Let's start with a discussion on the markets, that bear market territory we hit, and what's going on and where we go from here.
Thanks, Jeff. I gotta say, you're a ball of sunshine this afternoon. As you mentioned,
when markets are green, I'm a lot happier. I'll tell you that, Cliff.
That's right. That's right. Well, first off, just want to acknowledge, we understand this has been a very difficult environment for everyone. The 60-40 stock bond portfolio, which is largely seen as the world's retirement portfolio, is down almost 18%, which is the worst start to any year since 1962, which just so happens to coincide with really the first year that daily prices largely started being tracked. So comfortable saying what we've experienced with the 60-40 is the worst year on record, worst start to the year on record. No one likes to be down. We have done quite a few things. We've continued to evolve. We've continued to innovate to help smooth the ride where we can. And I am happy to point to our alternatives portfolio, as Jeff mentioned. If you've been following us, we've been pounding the table on the need to diversify into something that's not correlated, really for the better part of 2 years. And happy to say that the majority of our clients have taken us up on that. Our alts portfolio is actually positive year to date, but unfortunately not enough to offset declines elsewhere. But am happy to say that our clients are a lot more better off than most. And so we're going to keep working. We're going to keep doing everything that we can to get everyone back on track. But as Jeff mentioned, in these times where panic and fear are palpable, I think it's great to zoom out and just remember the long-term perspective. What is really most important for clients and for investors is to make sure that you're on track with your financial plan. In times like these, it's always great to look back at the plan and see how things are progressing. Because after all, that's why you invest, right? We invest to achieve our long-term goals. And so even though it has been a difficult year, if you zoom out, just looking at the past 3 years, for example, we're down 24 this year in the S&P, but over a 3-year horizon, the S&P has done just what it does on average, about 10% per year over the past 3 years. 60-40 portfolio, even though it's down 18 year to date, over a 3-year period has averaged 6. Which is in line with what many of our clients need over the long term to achieve your goals. And so just wanted to give a nod to that perspective before we get started. And then wanted to give a quote from one of my investing heroes, call him the GOAT, the greatest of all time, Stanley Druckenmiller. He's a hedge fund manager who in his heyday averaged 30% a year. Would like to spend some time with him, but this was a quote that he gave at a recent investment conference. He says, "I've never been presented with a cocktail where you have 8% inflation, the economy is going to weaken, and bond yields are at 3%. It's an analog with no precedent in history." So for the golfers out there, it's like going into to play around without a driver and without a 60-degree wedge, which I don't know about you, Jeff, but I don't think I'd be any good without either of those tools in the toolkit. So just wanted to give a quick nod to there before we get started, and then we'll kind of dive into our top three things. As Jeff mentioned, officially we've fallen into bear market territory in what has been just relentless selling, especially during the month of June. The good news is we do think we're at or near a capitulation point, and so we're staying long risk assets at these levels in anticipation of what we think is going to be a material rally. Number 2, inflation. That has been the topic du jour really all year, and unfortunately is not going away. May came out, the CPI in May set a new 40-year high. We went back and kicked the tires on our process and all of our data, and our view has not changed. We're still of the view that going forward, both inflation is going to slow, but growth is also going to slow as well, but perhaps exceeds expectations through the remainder of the year. And then last but not least, if inflation is 1A, recession has been 1B on the minds of clients and investors. You may have heard the term the hard landing versus the soft landing. So we think the soft landing scenario, which while we hope for it and it's okay to be optimistic, we're planning for more of a hard landing or recessionary scenario. However, we believe that the recession is not imminent. It is likely to be more of a 2023 discussion, and that risk assets should actually perform reasonably well for the better part of or the second half of the year. So we'll kind of dive into each one of these as we move along here. So first, we'll just take a broad look at markets. As Jeff mentioned, the S&P is down roughly 22% from the highs. We've rallied the past couple of days. NASDAQ down 31. And we can look at year-to-date numbers here as well. But you can just see it's global, right? It's not just the U.S. EFA is developed international markets, EM as well, getting hit in line. And from a sector perspective as well, there really hasn't been anywhere to hide other than energy, which has had a positive run year to date. But as you can see, it's in a bear market as well, down 25% from the high, down nearly 10% in a month. So there's really been nowhere to hide from an equity perspective, nowhere to hide from a fixed income perspective either. As we look at these various subsectors of the bond market, everything from short-term tips out to long-term treasuries, everything is in the red year to date. You're getting drawdowns, even in tips, which are inflation-protected bonds. Just has just been a brutal global sell-off. But the good news, there is good news. We'll try to be balanced and give you both sides here. But we think we're getting to a point where the selling is coming to an end. We talked about the 60-40 portfolio, but as Jeff mentioned to kick off the call, there have been 11 bear markets since the 50s. We looked at each of these recessionary periods going back to 53. And what we found was that, even though there's a lot of bad news out there, we think the majority, if not all of it, has been priced in at this point. The median drawdown of 24% is right where we are currently from all recessions. And not to say that things can't get worse. They certainly can. The Russia-Ukraine war continues to drag on. Would love to get some positive developments there. But we think the majority of the bad news has been priced in. And here's that word again, Jeff. I feel like every time we get on a webinar, unprecedented comes up, but it's true. Again, in this scenario as well. So this chart goes back to the Great Depression, 1928, over 100 years. Out of the past 7 trading sessions, we've had 5 days where 90% of S&P stocks were down 5 out of 7 days. That has never happened before in over 100 years. We look at the Dow Jones over a 12-week period. The Dow has been down 11 out of 12 weeks. Again, going back over 100 years to the Great Depression. We've never seen anything like this, just with how relentless the selling has been. But like I said, I do believe we're getting close to a capitulation point. And one of the things that we look at as a part of our process is sentiment and positioning. So where is our competition? Where is the street positioned? And we look at hedge funds. This is data from Goldman Sachs. So this is the amount of short selling that's going on in the hedge fund space. And short selling is when hedge funds bet on stocks to fall, bet on stocks to go down. We've not seen hedge funds, by and large as a group, be this short going back to 2008. So, it's not just our clients, it's not just us that are feeling the pinch. Hedge funds as well are tipping the boat over to one side. So then if you expand it and you include other large asset managers and leverage funds, things like that, again, just understanding when everyone's on one side of the boat, we want to start being on the other side of the boat. Equity positioning is below zero, so negative, right? So, bear markets tend to bottom when people run out of stocks to sell. There's not any sellers left. We think we're getting to that point if we have not already achieved it. A little bit more good news, Jeff. Forward-looking returns are a lot more attractive today because valuations have normalized. This is a 30-year view of the S&P 500. Forward price to earnings estimates were at 16.5 today, which is below the 30-year average. That's a great sign for forward-looking valuations. The lower your starting point from a valuation perspective, the higher your average returns are over a period of time in the future. Other metrics that we track, market cap to GDP, and then throwing in the Fed balance sheet as well. From a Fed balance sheet perspective, we've really begun to normalize to points that are more in line with the last 20 years. Still a little bit elevated as market cap to GDP perspective, but certainly nowhere near the degree where we were even just a few short months ago. So a lot of the froth has come out of the markets. And we think, again, we're at a point where from a technical and a breadth perspective, so you look at, not just the market, but all the components that make up the underlying market. We're at a point historically, at least, the past two major bear markets, even back here in 2015, where from a technical perspective, we've gotten to levels that typically precede pretty significant rebounds. And so when you come out of a bear market, again, we looked at data going back to the 50s, you look at over a 12-month horizon, you're averaging 15% with a 75% hit rate. So 3 out of 4 times you get above average returns with a pretty high level of confidence. And so, Jeff, all hope is not lost. We certainly understand this has been a very difficult time. But we do believe that the clouds are beginning to part and that going forward, things are going to be looking a little bit better than what we've gone through the first half of the year.
Yeah, thanks, Cliff. I mean, again, we do these webinars, or you send out your commentary, right, to get our input and what we're thinking from the data that we're seeing. Try to ease some, again, going back to those emotions. Yes, we realize, again, no one likes to lose money or go down or see the values drop as they have. It's been as I mentioned earlier, from just 5 months ago, we were at all-time highs to now at 20% bear market pullback, and what we've seen right now. So again, we want to continue to here's what we're watching, here's what we're seeing. No one ever can call the bottom, but there's a lot of signs that things are looking to improve from where we are today. So, Cliff, we just spent some time talking about market and the conditions, but let's talk about that big one, and that we cannot turn the TV on or pick up a paper or Google something without inflation coming into the picture. So let's talk about inflation.
Yeah, Jeff, and I'll just echo your comments on emotions, and that's again why we go back to process and we use probabilities, right, in what we do, and we're not going to be perfect, but I think we can hold our heads high and continue to work and get better and rely on the things that we've built to come through the other side of this. So yeah, as we shift gears and talk about inflation, the May reading was really a big surprise to everyone. We thought we were going to get a little bit of relief on the inflation front, but no, unfortunately accelerated year over year to 8.6%, which was the highest reading in over 40 years. But when you look at the breakdown and what actually is driving the inflation numbers, it's really two things. It's energy and it's food. As you can see here, these bars here on the most recent side, energy has overwhelmingly been the largest component. And so then what we did was we looked at year-to-date inflation just from January to May and provided a breakdown of what that looks like. And what we've seen is that 40% of the inflation to date has been driven by energy, oil and gas, diesel, so on and so forth. And then another 15% has been driven by food. So over half, 55% of the inflation numbers that we've experienced are driven by two things, which are highly volatile and highly cyclical, which is the good news. We think we'll be getting a little bit of relief on this. If you look at oil prices, we've broken down below $105 a barrel as of today. So that may provide a little bit of relief on the commodity front. But the other side of the coin, the bad news on that is that the Fed is essentially powerless to really do much of anything about energy and food inflation. And we'll look at a little bit of data on that. The other piece is core. So if you strip out food and energy, core inflation will be running about 5-6%, high but manageable. But then of that, really, it's been housing. That's been the largest component of core inflation. Again, we do think that as rates rise, mortgage payments, compared to when you could have got a mortgage at 2.8, 2.9, 3%, we're now at 6% mortgage rates. Likely to be some relief on the shelter front as well over the coming months. So we looked at energy, right? Because energy is the largest component of inflation. We really wanted to understand the key drivers of energy and what happens with oil prices. And this is some work that was done by BlackRock, one of the teams that we own in our bond portfolio, our flagship bond portfolio. One of the managers, Rick Reeder, and his team did some interesting work on this, which they shared with us. And so what we found was that the Fed's problem is inflation. The Fed's problem is inflation. Energy is driving inflation, and energy's problem is Russia. Because what we found was that the Fed is able to help slow the economy and help slow the demand side, but oil is actually driven by supply, is what history tells us, and actually not by demand, which is very interesting. We looked at some historical periods. So you can see in the 70s, this is a great example. Oil consumption is this red line, oil price is this yellow line. And so what you saw, and this is from the oil embargo and everything that was going on in Iran, oil consumption dropped tremendously from about late 78 into the early 80s, but price skyrocketed, going from, we'll call it $12 a barrel up to $40 a barrel during that same period, even though demand collapsed. It wasn't until OPEC started boosting production and everything came to a resolution with Iran before oil prices came down and stabilized. We'll look at more recent periods of history going into the great financial crisis of 2008. Again, oil consumption starting about 2007 really came down tremendously, but oil prices spiked. And on the other side of the coin, even though consumption patterns were higher, prices fell back in 2015 and into the 2020s because of the supply picture. So that's the problem on this right-hand side. If you look at Russia, it's the third largest producer of oil in the market, over 11 million barrels a day. We've got to do something about the supply picture for these oil prices to stabilize and come down. So would love to see a resolution to the Russia-Ukraine war. Would love to see some of our policies shifting toward making maneuvers to get energy supply back online here in the U.S. But until we can move the needle on either of those, likely to continue to remain volatile on the energy front. So Jeff, that's the backward look. As investors and our clients care about the future and what's going forward. And I'll start with the inflation picture. So our models are indicating still, even though the inflation is high and keeps rising, that we are likely to peak out during the second quarter. And so we're in June. I think the June number will probably be fairly similar to what we saw in May, 8.5 range for June, before beginning to drop off third, fourth quarter, and then into the first quarter of 2023. So that's the inflation picture. From a growth perspective, we've been in this environment of quad 3 where growth slows, inflation accelerates, perhaps trending over here to these quad 1, quad 4. where what do they both have in common? Inflation decelerates. So from a growth perspective, if you look right now, our models are saying third quarter actually might be pretty decent. So if we peek into a quad one for the third quarter, we think that will really help with risk assets, especially given how depressed sentiment is. And then would give us an opportunity then to continue to position our portfolios for what may be two consecutive quarters of quad four going into year end and into 2023. So there'll be a lot more to come on this. The data will change, and as the data changes, we will continue to change and adapt our portfolios and our process. So that's the story on growth and inflation. Jeff, the other topic on everyone's mind is the R word, as you alluded to, and the hard and soft landings.
Well, yeah, Cliff, a lot of good points in there, right? When I think there's a positive where you saw the U.S. is the largest producer. What we don't show on that chart is probably consumption, the largest consumption, I'm not sure of the word consumptioners of the oil, right? And with U.S. being a large, we can't supply Europe, right, which is also a big consumes a lot of gas, oil, and also gets a lot of their supply from Russia. So as it is a lot, again, this whole oil and gas with the price, and then also just we think the driver of oil is or the price of oil being the demand, and again, just reminder, it's the supply. So again, it's and unfortunately the Fed can't control that to the level or control that at all. So let's talk about the Fed, Cliff. Let's talk about you hear the wording hard or soft landing. We know the Fed began their tightening cycle earlier in the year. So and the most recent was just a week or so ago. So let's talk about what's going on with the Fed and where we see the direction of the Fed going.
Yep, Jeff. And so just for those listening at home and watching, really the only difference between a hard and soft landing is whether or not the economy tips into a recession. So either way, growth is slowing down. The Fed is trying to slow down demand. And the way that they do that is by hiking interest rates, and then by quantitative tightening is their other tool in the toolkit. And so to kick us off, as you mentioned, roughly a week, 10 days ago, they announced the largest interest rate hike. So 75 basis points, 0.75%. It's the largest increase since 1994. No surprise there that they went that much because of the inflation readings, but also because 1994 is largely considered to be the last time that they were able to engineer a successful soft landing. So no surprise that they kind of went back to the well there. So if you look at recent commentary, they're certainly committed to that the part of the mandate of controlling inflation, perhaps at the expense of a recession. Even Powell is admitting that a soft landing is going to be challenging. Doesn't mean that it's impossible or that even if we do tip into a recession, that it's going to be anything like 2008. We actually think the economy is really great shape when you look at the consumer and you look at the business perspective, but certainly going to slow things down as they continue to tighten. So what is currently being priced in for July is almost another 3 hikes, so another 75 basis points in July, perhaps even another 75 basis points in September. That was not as high level of confidence. But then you start looking at 50s and 25s for the rest of the year before ultimately, based on what the Fed is telling us now, their plan is to get us to about a 3.8% terminal Fed funds rate. So I, for one, don't believe that they're going to be able to get that high before they have to pause. We'll see. But as these growth numbers begin to slow down, and if inflation can slow down and we get 2 or 3 months worth of trending in the right direction. Again, rate of change. We care about rate of change because the market cares about rate of change. If we can get some evidence that we're heading lower, that will certainly allow them to ease off what is now considered a more aggressive stance. So as we always do, we go back to consult history in these unprecedented periods, Jeff. And so what we did was we went and looked back all the way to the 50s. There have only been 3 successful soft landings in modern economic times: 66, 84, 94, and then we'll give the Fed the benefit of the doubt 2019 before COVID hit. Let's say potentially 4. The problem is, as we've discussed ad nauseum, is inflation. And so then we looked at periods, during this time where, you've got high inflationary periods, which we categorized above 4%, low inflationary periods below 4%. And when you break the world down into those 2 regimes, there's actually only one successful soft landing, and that was 1983, 1984. Coming out of Volcker and Reagan, so a little bit of a different time period. And in fact, during this high inflationary period from 1969, so here to 1982, the economy, there were 4 recessions, and the economy was in recession roughly a third of the time. So certainly going to be a challenge for the Fed, but we certainly don't want to scare anyone, because there is a bit of good news. Even if we do fall into a recession, we don't think it's baked in the cake, nor do we think it's imminent. Now, we could have 2 successive quarters of a negative GDP print because of the trade and because of the inventory issues. So, you could debate whether or not we technically fall into a brief recession. But if you look at the consumer and the strength of the domestic economy, definitely not recessionary period at all. And so we've hit on these before. In the most recent Cliff Notes, we dove in even a little bit further. But there are really 3 primary reasons why, even if a recession does come, it's likely not imminent and it's likely to be shallow. First, consumers are sitting on piles of cash. So this yellow line here is what is considered excess savings. So savings that happened from the pandemic that are over and above a normalized rate. And there's still over $2 trillion. So that's 10% of GDP in excess savings on consumer balance sheets right now. So, even though prices are going up and things are more expensive, and we can see consumers have started drawing on that pile of savings over the past couple of months, there's still a lot of runway left to be able to draw those savings down and support the growth in the consumption of the economy. Secondly, the labor market is the healthiest that perhaps maybe it's ever been, or at least the healthiest it's been in a generation. Unemployment's at 3.6%. We look at job openings versus quit rates. So an extremely tight labor market. There are still 2 open jobs for every unemployed person. Wages are going up as well, so that will support the consumer being able to shoulder the burden of some higher prices for a period of time. And then last but not least, no one talks about this. I don't know why for the life of me, but if we look at CapEx, which is companies that reinvest their profits back into their businesses to get more efficient, to get better, CapEx should hit a new all-time high and is actually re-accelerated over the past couple of readings, as you can see on the right-hand side. So investment in efficiencies and putting money back into businesses is going to be a major requirement as the world changes and supply chains adjust. And so we think strength in CapEx will help to buoy corporate profits, which, as we know, speaking of profits, earnings season kicks off in about 2 weeks, where the major banks report. And I won't go through all the data here, but I will call out this 4.3%. That's the estimated growth rate for second quarter. Historically, earnings tend to beat estimates by anywhere from 3 to 5%, we'll call it. So there's a chance that, I don't know that we'll do another quarter of 10% earnings growth, but mid to high single digits, I think, is pretty reasonable for second quarter. If we get good news on the earnings front, we get a little bit of a break on inflation, and the Fed can kind of pause and reset expectations. You combine that with just rock bottom sentiment and positioning, everyone's short, everyone's out of the market. We think we could be setting up for a pretty nice rally here into the second half of the year. So from a portfolio perspective, what are we doing? First, I'll tease out the death of the 60-40. Yeah, absolutely. We think almost every client, if not every client, should have some alternatives in their portfolio. It's like a shock absorber. Would you ever drive your car without a shock absorber, without your shocks? For me, at least the answer is no. So still want to continue to pound the table on alternatives. But on the equity side, we want exposures to things that work in a growth slowdown. We still do have some energy and commodities exposure. We'll begin rolling some of those off and getting rid of some of those. We've already started that process. But from a factor perspective, we want things that have high quality. So current earnings, current cash flows. We want stocks that have some growth, because as growth in the economy slows down, investors will pay up for companies that can exhibit strong growth tendencies regardless of what happens in the macro cycle. And then low volatility, so more defensive types of stocks we think will continue to do pretty well. Outside of the US, emerging markets we think are really interesting. Valuations are extremely attractive. They're about half of what we are here in the US in some markets. So we have started adding to some emerging markets. We also think the dollar is close to peaking out if it has not already done so. We're at 20-year highs in the US dollar relative to our trading partners. When and if the dollar comes down, that will be a boost for emerging market stocks and bonds. And then we're going to be nimble, especially in our more tactical portfolios. So we are currently fully invested. We're all in at this point on the equity side in anticipation of, like I said, what we think is going to be a pretty significant rally. But we do ultimately think for this year, markets are going to be range bound. So it will be difficult for us to put in and sustain new all-time highs at about 4,800 on the S&P. But we do think that at the end of the year, we're going to be higher than where we are today. And when the book is written on 2022, it's likely not going to be as bad as what we're experiencing now. Fixed income, I'll just highlight here. We think this is high quality investment grade bonds is really going to be a nice place to be for the next 12 months. So we've been doing that in our bond portfolios. We're extending our duration, which is interest rate exposure, because those are the kinds of things that we want in a slowing growth, slowing inflationary environment. So we can get, I say target 3 to 4. We think we can get north of 4 in a pretty high quality bond portfolio, with the chance for some 4% yield, with the chance for some price appreciation. We think bonds. We think we'll get a positive return in bonds for 2022. So more to come there, but don't abandon your bonds, even though they have not served as their traditional diversifier. We think they likely will because of the environment. So just 3 key takeaways, Jeff, before I turn it back to you. Volatility will likely continue. We've got some things coming up, midterms. We're just getting started with the midterm election cycle. So there could be some volatility as we continue along that path, but we do think ultimately we end the year higher. From a macro perspective, growth and inflation are going to slow. We do think recession risk is muted for at least another year, which gives us ample time to earn back some returns and then reposition as we get ready for it. And then last but not least, don't abandon your bonds. We like high quality, plain vanilla investment grade bonds. And we think that they're going to perform pretty well for us second half of the year and into 2023. So with that, Jeff, I will turn it back over to you. And thank you.
Thanks, Cliff. Now we talked a lot again, as always. We discussed the market. We talked about the bear market. We talked about the Fed. We talked about inflationary pressure. And then again, just wrapping up with how we're positioned, right? This has been, I know the question I've gotten from some clients is, what do I need to do? Is there anything I need to do differently? Or what do we need to remember? We're doing anything that needs to be done differently. We're already doing it behind the scenes, and Cliff and the investment team is taking those actions to make those adjustments. If there's things that need to be made different because of a change in your life, your situation, whatever's happening, those are discussions to have with your advisor. When we look at what also is coming, again, ahead, we've got the midterm elections. We'll certainly have some conversation, whether leading up or after, to just talk about what market conditions. There's a lot ahead as we move forward into the second half of the year. Earnings season starting in July for the second half. Positioning of the portfolios will continue to be adjusted. You remain patient. The plans are in place. We have not abandoned our rate of return. We have increased the inflation rate we're using in plans. So a lot of the things that need to be done are being done behind the scenes and that you may not even be aware of. So we want to thank you for joining us. Again, we'll have this posted to the website, to our social media sites, etc. If you have questions, reach out to your advisor. You can call Cliff or myself to have a further discussion on this if you want to dive deeper into your situation or just talk a little further. But again, thank you, everybody. If we don't see you, stay cool. It's I guess not as hot as today, but it's going to be a hot summer. It certainly seems to be. But we thank you all. We thank you for your trust and confidence, and wish you all a good summer and safety and everything else that could go with it right now. All right. We just got this crazy market. So thanks, everybody. And we'll talk to you soon.